Hello everyone, here is a brief introduction to the closing process in accounting. How exactly are accounts closed? Well, the fancy definition states that closing entries are made that transfer the balance of temporary accounts to owner's capital at the end of every period in order to prepare the books for the next period. Well, what does that mean in common terms? It means we need to divide our accounts into two different classifications, and they are temporary, or sometimes called nominal accounts, and real, or sometimes called permanent accounts. Temporary accounts are the accounts which track the amount of something within a given period of time. They are our revenues, expenses, and withdrawals. Real accounts don't track anything. They show what the value of something is at that given moment. How much are your assets worth on that day? How much do you owe to creditors, your liabilities on that day? The difference in the need to close between temporary accounts and real accounts is how these things come off the books. For real accounts, how do things come off the book? Well, let's say that you have equipment. How does your equipment come off the books? Maybe it loses value over time. Maybe you sell it, but there's some kind of transaction or event that happens that causes the value of that account to decrease. Same thing with liabilities. You pay off your credit card. You pay off your bank loan. Those things are natural events and transactions to a business which will cause that account to decrease. Our temporary accounts, with a few exceptions, don't have any event or transaction that are going to cause those to decrease. You put revenues on the books whenever you provide a service or sell merchandise, but how does it come off? There's nothing that would happen normally that's going to cause your revenues to decrease. So if we didn't have some kind of method in the accounting system for removing these accounts from our books, they would just continue to grow and grow and grow over time. So these temporary accounts are going to be closed at the end of every period, and I'll get into the how of that in a second, while these real accounts, or assets, liabilities, and capital accounts, are not closed at the end of every period, because there is some other way that they're going to come off our books or change eventually. Let's take a practical example of why we do this. Why do we close? And let's say that there is a bank, and this bank only has enough money to lend to one particular company looking for financing. So when companies call them, the bank's going to say, how much income does your company have so that we know that you can repay this loan that you're asking us to make to you? There's two companies that are applying. First one is company A, the second one is B company. Company A says to this bank, well, last year we had net income of $500,000. That looks pretty good. B company says, over the last 5 years, we have had total net income of $5 million. Well, 5 million is better than 500,000. So just from that information, that's a bigger number. It looks like they can probably repay the loan. The problem is it's not the same period of time. Company A has 500,000 from last year. B company has 5 million over the last 5 years, but from that information, we have no way to know how that income was distributed amongst those 5 years. Are they making more now? Did they make more in the past? But what if we broke it down into periods and we looked at company A's income over the last 5 years, and we saw that their income has increased each year for the last 5 years up to the $500,000 it currently is? Well, what they said is true. Last year they did have net income of $500,000, but what the story doesn't tell is that they are becoming a more successful company each and every year as time passes. B company, however, with their $5 million in total net income over the last 5 years, has a breakdown as such. In 2016, they made $2 million. In 2017, their income was down to $1.5 million. It stayed there in 2018. In 2019, it declined again to $1 million, and then last year in 2020 they lost $1 million. They had a losing year for B company. Well, now if you're the bank, you're looking at who am I going to lend this money to? It's obviously company A, because company B lost money last year. They're going to be able to repay you if they're losing money at the current time. So breaking your information down into periods lets people who want to use your information, this bank in this particular example, have information that is more useful to help them make decisions. Let's do the same concept but with expenses. So let's say we have the Dinner Time Picnic Table Company, and they have produced 10,000 picnic tables per year for the last 3 years. Another furniture maker, another company is thinking about buying out Dinner Time, and they want to know as much as they can about that company's profitability. In particular, the one thing they're really interested in is how much is dinner time spending in labor costs, paying their employees to make these tables, over the course of making these tables in the last 3 years. Well, if dinner time says our total labor costs for the last 3 years were $885,000, sure, that's useful information. It lets this other company looking to buy them out know what their costs are, but it doesn't let them see the trend. It doesn't let them see how that company is changing over time. It's not as useful as it could be. So if dinner time broke it down, and they said in 2018 we spent $250,000 on labor costs. It went up to $300,000 in 2019, and it went up to $335,000 in labor costs again in 2020. Well, now this other company looking to buy them out sees the trend, and they have more useful information. They're going to look at this and they're going to say, are your costs going up because you're making more tables, therefore it requires more hours to make them? And from our question, we can see that's not the case. They've made 10,000 picnic tables each year for the last 3 years. So now this other company looking to buy them out has to ask dinner time, all right, you guys got to explain to us why your labor costs are going up every period. If we're going to buy you out, we don't want to be spending more for employees than we have to make these tables. So by breaking things down into periods, this other company has more useful information to decide if they want to buy out dinner time or not, and for how much they would offer the company. And this concept that I'm talking about, where information is more useful, is called the gap periodicity assumption. The way that accountants keep their books has to assume that all of these activities that are ongoing and constantly happening for a company can be broken down into periods, because companies will typically report annually, quarterly, monthly. Some companies report, every month. Some companies, most publicly traded companies, report quarterly and then also annually at the end of the year. So if we can break things down into periods, when we put those financial statements out there, the information within is just for that period, and it lets users of our information have a better idea of what exactly is going on inside of our company. This is more useful because the phrase that I like to say is, today matters more than yesterday. If we put out financials that show what our income was during the current quarter, that's more useful to somebody than saying, well, this is what we've had over the last 5 years, or this is what we were doing a decade ago. Every time you go into business with somebody, every time you ask for a loan, they want to know about today. It makes the information much easier to interpret. Nobody has to go through and look at your financials and decipher that information for themselves. That's all right there in front of them. And the biggest one, and you just saw it in the last 2 slides, is you can see a trend. You can go back and look at every financial statement a company has put out over time, if you're an investor looking to buy into the stock of a company, and see, is their income going up every period? Do they have more assets than they used to in the past? By breaking things down into periods when we report, it gives more meaning to our information. Okay, so that's why we close. That's all of the information, around the concept of it. But how do we actually do this? Well, how you close is you reduce the balance of your temporary accounts to 0 at the end of every period. And again, those temporary accounts are your revenues, your expenses, and your withdrawals. Why? Because if we set these accounts back to 0 at the end of every period, every time we record a journal entry, it's naturally, innately tracking what happened just for that period, because none of the stuff previously before that period started will be into that account. Important piece of information right here, which is another thing that commonly gets missed in here. You always close your accounts after you've made your financial statements. Revenue is one of these temporary accounts that we're going to have to reduce to 0. What would happen if we reduced it to 0 before we made the financial statement? We'd be reporting service revenue or sales revenue of 0 on our financial statement when we give it to somebody else. And it doesn't look very good if you're going to hand to a company and say, can we have a loan? We had $0 in revenue. No, you report your revenues and expenses and withdrawals first on your financial statements, and then after you've prepared your financial statements, then you reduce them all to 0 to prepare them for the next period. Why don't we close permanent accounts? Well, again, your assets, your liabilities, and your capital account show the value of something at a current moment in time. What would happen if we reduce these to 0? If we reduced our equipment to 0, we'd be saying our equipment's worthless, or we don't have any equipment. That's probably not the case for your company. Same thing with inventory. You wouldn't have anything there to sell someone else. What about liabilities? Well, if you reduced your liabilities to zero at the end of the period, what your books are saying is that, hey, we don't owe anybody any money. And if you had, say, a $20,000 loan from a bank and you close it because I want to close accounts, all of a sudden you're saying you don't owe the bank any money. And I doubt the bank is going to agree to that. So you're essentially reporting false information by closing it. And equity accounts is the big one right here. Never, ever close an equity account at the end of the period. And by that I mean never close your capital account at the end of the period. Why? Because your capital account is the value of the business. We're going to make some journal entries when we actually go through the process of closing. And it's going to use your owner's capital account in those closing entries. And students like to think, okay, capital accounts are in the closing entries. Everything in the closing entries has to be reduced to zero. No. Only revenues, expenses, and withdrawals. Your capital account, your equity account will have a balance at the end of the period, because if you reduced it to zero, you would be saying that your business has zero value. How do you remember what accounts to close? And here's an old man story, but I'm going to stick with it. Back in the day when VHSs were the way that people watched movies and you would go out and rent them, there was always a sticker on top of every VHS that said, "Be kind, rewind." And they put it there because people that were renting these VCR tapes would have to rewind it to the beginning of the movie. You want to put something back to the way that it was, that it starts. Well, that's what we're doing when we close our accounts. Rewind starts with the letters REW, which is the same letters that start revenues, expenses, and withdrawals. So if you need a mnemonic to help you remember what accounts get closed, remember that you rewind all temporary accounts to zero at the end of every period.